just sounds like you need a bigger pipeline.
Yeah.
But
well, it was sticking it on a hoodie.
It's almost like if you slow down, you can speed up longer term rather than having a headache and a world of pain.
The return on cash potential from investing in our own business is also quite high.
I can relate to this massively because our construction business was built in the fire of high levels of inflation.
I don't think people that are not in the sector realise how big the inflation problem was in the construction space.
Yes. I can't wait to look back on these podcasts in 20 years' time on the back of Dorian's yacht. He's taken over Wales completely. Yeah. Looking forward to it.
Yeah.
His yacht in Cardiff.
Yacht.
His toy yacht in the bath.
Ground up sound. Ooh, yeah. Real estate deals. We lay them down. Let's get those deals. Deals making money, baby.
Welcome back. This is episode 24 of the Ground Up Podcast. We don't have JJ with us today because he is flying back from Vegas literally as we speak. He may be trying to join the podcast, but we'll see if he does. It's 6:30 a.m. We're cracking on bright and early, and we've not seen D. I don't think we've seen you for about 2 weeks because we had a week off. We had a week in hand, and then last week me and Stu did a Bitcoin deep dive, which D, you must listen to because, you know, Bitcoin, baby.
It's aimed at you, mate.
Sort of shit. It's literally, we went, this podcast is for D so that we can orange pill him and get him to stop buying sites and start buying fucking Bitcoin. But anyway, we're not going to talk about Bitcoin today. Today we're going to talk about construction. So it'll be interesting. But we'll start off with just an update because D's making a lot of business moves at the moment. So D, give us an update. Where are you at? How's life? How's business? How's cash flow?
Yeah, good. It's a very busy time. There's obviously a lot happening, and when you touched on there about Bitcoin, my biggest problem with Bitcoin. I actually don't have any issue with Bitcoin. My problem with it, from like an investment point of view, is you need cash to park into it. It's one of those investment strategies that, at the moment, anyway, until you can do some other fancy stuff. And what has definitely been is you need a lump of cash and you invest in Bitcoin and you sit at it, park it in, and watch it grow. My problem is the amount of deals in our pipeline is phenomenal, and to service those requires so much capital that, you know, that's where all the direct investments going into. And then when you look at the business and how can you improve the business, it typically requires making some form of investment into something else, whether it's an acquisition or a new division or a new sector, whatever you're going to do, or new hires. You need to allocate money and park it there, get in that business and that venture for, 12, 24, 36 months. So that's my problem, is that I've got a waiting list of investments to put into that in theory, if it goes well, we'll turn a return on capital, return on the cash employed in the hundreds of %. So that's always the challenge, the difficult thing. But yeah, in terms of go on, mate.
I was just going to say that's just to relate. That's the same exact situation me and Robbie find ourselves in with this business. Is like, we could put 10 grand in there, or we've made a load of new hires. We know we want to finish up the office and do some other bits. Like, we need to really allocate the money there, but we're trying to at least dollar cost average, just $1 grand or $2 here or there on a more frequent basis. You could do the same, D, even if it's 50 quid. 50 quid. You can't give me cash flow shit. 50 quid.
No, I don't disagree. It's just the issue is it's your
attention time at the moment. You're so focused.
I mean, but
you're
saying
you're so focused on what you need to do, D. You've got so much to get on with.
Yeah. So it's just the return on cash potential from investing in our own business is also quite high. It's because in my particular business, we need about 1% of a total GDV effectively in terms of equity requirement from the business to go. So if we did a £10 million deal, I need 100 grand effectively to do that, the way we structure things. So if you make even a 10% margin on that 10 million, and your cash is 100 grand, and you also get that back really early on in the deal, your return on cash employed is really, really high from a percentage point of view. So then when you compare that with Bitcoin, like, don't get me wrong, Bitcoin, even the projections are all very good, but they actually still don't quite compare to if the business goes well. Now that's the gamble you take, isn't it? Is that I'm also not diversifying, but
yes.
What's that saying? I can't remember who said it, whether it was Warren Buffett or whether it was Andrew Carnegie. I think it was Andrew Carnegie actually. He says, I'd rather my eggs in the basket and I just spend my time looking after the basket, so rather than lots of eggs in lots of different places, that, could get.
No, but D, you only need it in
up.
2 places, just 2, Castell and Bitcoin. That's all it is. That's all it is. I'm just saying.
I know.
Castell,
it's just this business. we're investing literally 6 figures a month, 7 figures a year into every year. But look, I take your point on board. But that's my reason at the moment why I'm just why it's still not really there.
And how about the groundworks?
I was going to say, talk us through your projects at the moment, then, D. So you've got obviously a few that are in planning, a few that have got some conditions you need to try and clear.
As it stands right now, we're in construction of just shy of 250 homes, live homes. We've got sites obviously ending, we got sites starting, but the business is effectively a machine. We're a land-led house building company specialising in the social and affordable sector, as you know. Our business model runs on us identifying sites, forward selling them, getting planning. The clients buy our sites and then give us a build contract, and then we go from there. Now, we already budget that sites take about 2 years from start to get on site. About 2 years is what we anticipate. So it's a hell of a long time. And what should be happening right now is we should be on 3 more sites than we're actually on. They're all there, and they've either got planning or informally got the consent. But the delays at the moment are phenomenal. It's like, without boring people, not with planning, to get planning what we do, because it's all new build, it's full planning, there's no PD stuff. It's there's a pre-app and then another pre-app, and each one of them is 3 to 4 months each. Then we've got our pre-application consultation, which is another month and a bit. Then we finally got the actual full planning application, which is pretty much only the timescales people talk about and hear about. But we've now just done 10 months before getting to planning. So now we're at full planning, and we're in that for 12 months. After planning, and which a lot of our sites are at the moment, we're waiting for Section 106 agreements, which we just had one come through now. We still don't have the signed 106, and it's for 20 units, no obligations, or like $5,000 worth of obligations. And I kid you not, it's taken 4 months. 4 months. For that. And the sites had planning 4 months ago, but you can't get the decision notice until the Section 106 is done. Only then you've got the decision notice. Then you've got a 6 weeks judicial review period that no one really buys the site in, because it could get called in, even though it's unlikely, but still. And but then we've got to discharge pre-commencement conditions. But we can't do that until we've got the decision notice. Obviously, you can't do that until we've got the Section 106 signed. So it's been sat with the council after all the negotiations. It's with the council, and they say, right, great, Section 106 is now all agreed. We'll now sign it in 2 weeks. I'm thinking, why? And so they say, because that's just when we will sign it. So like that happens across all of our sites. So anybody looking to scale up in development, you've just got to be prepared for that. My biggest advice to people going into development is make sure you have a cash flow and trading business alongside, so you can ebb and flow those ups and downs. But ultimately, we've got now for the next 5 months, 5 sites due to start, which is what it is. It's going to be a busy period, and as long as they start, things are all fine. But I've been spending a lot of time thinking about how to improve the business, because our business model is a fixed price business model. We've de-risked the sale, we've de-risked the funding, because we forward sell to basically government grade clients, and they fund the project. So we've got the funding risk at pre-planning, but we de-risk that by optioning things up and really reducing the amount we have to invest. We're now left pretty much with the delivery and execution risk, because the last risk we got left is we're in a fixed price contract. If we don't deliver on the price we say we're going to, only us loses out by loss of margin. So we've been looking at ways to increase the profitability of the business. And one of those ways was through vertical integration, by going into the supply chain a bit. And with new build, because about 25% of our revenue comes from groundworks, the groundworks element, we launched our own civils division last year. That's now scaled up over the past of the 12 months, and it's now done about 4 million in revenue in its own right, and that's adding currently that's adding a net contribution to the group of 11%, which is good. That's what you want.
And it's important to note as well that that's not 4 million additional sales you're having to find. That's you folding in more margin and gross revenue from your existing pipeline, right? So you're taking over more control of gross revenue
correct.
that's coming to you anyway through your sales.
Yeah, correct. Yeah, so it's the one good thing we have as the main company is that we've got 3 years worth of sites in front of us, and so that 4 million of revenue is what the clients pay the main construction company, which we are now subcontracting to our groundworks division. And then we've also been looking at expanding into the M&E sector, because about 15% of a project is M&E, and it's nowadays we have solar, fire sprinklers, electrical, plumbing, ventilation, door entry systems, etc., and it's a big package. So yeah, we've been exploring, looking into that, and I was just doing a program and cash flow based on that. And if we rolled it out in the next 13 months, that M&E division could very well be on its way to nearly £1 million, £10 million revenue division in its own right as well. And if we could capture
how would you do that? How would you phase that rollout? How would you integrate, from where you are now, just out of interest, how would you do that?
So we structured when we structured the division, the civils division. I had four key KPIs that, if we hit them, would achieve the last KPI, which arguably is obviously, from a business point of view, one of the most important. And my mental thinking was very simple. Obviously, we've got the workflow already there, the pipeline already there. So if we could deliver on time to a program agreed by groundworks and construction, and obviously we know how long things take. If we could deliver to quality, so we get things right the first time around and don't have to rip things out. If we could, with our commercial and buying team, buy materials and plant and hire at the best prices, at the best terms in terms of payment terms as well. And then if we could run all of our sites safely and systemized and process driven and no accidents and all that sort of stuff, then we're pretty much, without sounding cocky about it, guaranteed to hit number 5, the KPI number 5, which is make money, make a positive margin, make a contribution towards the group. So obviously running a division, you've got a different set of headaches, like building a team and all that sort of stuff. So what I did was bring in an operations manager and incentivize them by saying, right, this is the plan, here's the workflow, here's the KPIs, this is what you've got to focus on. You run it, you build the teams, you monitor them, you program the size, manage the resource, manage those KPIs, and I'll be looking at them as well on a monthly basis. You report to me. And just nail it. Focus on it, nail it. I'll help you with growth as we get there and restructure and all that sort of stuff and building teams. And that's what they did. And they're incentivized to grow into managing directors of that division. And touch wood, it's worked well for groundworks, and we're looking to replicate that same premise for M&E if we go into it. And the way it would work is the first 3 months, the first quarter is setting up the actual structure of the group and business planning. The next quarter is starting with one site and testing that theory. And then by the time we get to the third quarter, we've hopefully got a division with the relevant accreditations, got a business plan and processes and forms, and however we've got SOPs, basically draft SOPs, standard operating procedures for that division. We've tested them out on a live site, and we'll know whether we'll also have some KPIs back on the other ones in terms of quality, safety, and contribution. So we'll know whether to commence with quarter 3 onwards, which is start taking on more sites.
I've got a couple of questions, Dee. I don't want to go too far because I've got a couple of questions lining up here. Back to your planning stuff. So I've got 3 questions. Regarding planning, are you doing all your drawings and everything in-house, or are you externally using third-party consultants or architects? And how many architects are you spreading those 5 across? So basically, is there a bit of a bottleneck and things are stacking on top of stuff? The other thing was about discharge of conditions. Do you try and get ahead of the consent and try and knock them down? And how do you minimise the amount of conditions? And then I've got some other questions about fixed price contracts?
So the answer to question one is currently that our land and technical team will go out to external designers and get quotes and stuff like that. And we work with, between 5 and 6 different ones. They also get recommended from the clients as well, because, the social sector is quite a niche sector. So yeah, we go out basically. There's still cause a bottleneck. We have more of a bottleneck on engineering than we do on design. So but yeah, so design we're okay. But in the future, we've always considered talking about bringing it in-house or having our own element of design. But right now, in terms of an annual kind of cost, we spend about £1 million a year on design. So it is definitely important to look at it. But right now, it's not causing a big bottleneck. The other answer to your question is conditions. So we try our very best to get them worded out during application stage. We try to provide as much information as needed at planning stage. So we typically nowadays do 2 pre-apps as well as a pack when we get the planning, but we still have a raft of pre-commencement conditions after all that. So if we just can't seem to get to, and we've spoken to some that they don't give us the draft report until they basically go to committee. And then when we request changes at that stage, the planning officers, basically say, no, we don't want to redo our report, basically. So we have to sometimes we've NMA'd, we put in applications, non-material amendments to reword conditions to change them from pre-commencement to stuff. And then, but the biggest thing we do is, because there's a JR period anyway of 6 weeks, which we can't really ever sell the site in 6 weeks. What we try to do is get the draft decision notice and conditions, list of conditions early on. So our team get a whole application ready. So as soon as we have the decision notice, literally the very next day, ideally the same day, but the next day we are submitting a condition discharge application. Although what sometimes happens is they'll give you the draft report and decision notice and conditions, and then when it actually goes to be formalized into a decision notice, the conditions change. So and they don't tell you about it, and then that causes about a week or 2 delay. But normally we're very geared up, and then the condition discharge period is meant to take 8 weeks, so it coincides quite nicely with the JR period. It never really takes 8 weeks, so it's always a bit longer. But we put a lot of pressure then on the planning, especially if we're geared up with the buyer on the end side, and we just want to get going. So the biggest thing that irritates us is pre-demolition. A lot of our sites have remediation or demolition, and there's no reason why we can't start them. If you're going to go onto a site and remediate it with like removal of knotweed and stuff like that, that's about a month's work normally. You're going to do demolition as about 1 to 2 months work. If we get on with that, we could discharge the rest of the conditions. But like we've got one now, they won't discharge the demolition condition until we deal with the landscaping thing, which won't actually come into play until the end of a job.
Yeah, it's mental, isn't it?
I've got that. So one more then. So you're bringing in the M&E. How do you factor in your, increasing your exposure to like design liability and things like that, particularly with M&E?
So with M&E as well, you can also subcontract out to M&E designers, but ultimately we are not really building complex things, right? We're building apartments and houses, or bungalows. Those are the 3 things we're building. Right? It could go wrong. Definitely, it could go wrong, but we're not building intricate, hospitals.
Office blocks.
But even the bigger extreme than that, office blocks that require, lots of different tenants, lots of different M&E considerations, hospitals that if you get M&E wrong, you're literally putting people's lives at risk. We're not in that zone. If you have a group of Sparkies and they can't wire up a house, you've probably got a bigger problem. So obviously the design aspect, really the most important one from a design point of view is sprinklers, making sure that that's right and signed off, and obviously will perform if it does need to be enacted on. And we'd need. Go on.
I was going to say it's the same low calcs when you're doing residential dwellings. Once you've got it nailed, you sort of know the inbound connections you need and everything else. And if you're using the same teams, it's just copying this cookie cutter effect. But back to your fixed price contracts, mate. And now you said you've got, you were hoping to have 2 through planning already and on on the ground, and now you've got 5 stacking, because you give a fixed price contract to your customer, your end buyer. Are you not a little concerned that you're going to have 5 jobs you need to do all of them at the same time, which means you're going to put a bit of a load on your sort of internal processes and sort of contractors you're using, or are you just going to basically double down and take more contractors on to sort of run 5 concurrently rather than 3? Because that's a bit of a sticking point for the next 6 months.
Yeah, no, 100%. So, we will try to stagger the contracts the best we can, and managing cash flow as well. Is like whenever we get into a new contract with the client, until you sign that contract, they're very, very collaborative with you. They will work with you and stuff like that. So if you plan it in advance, you could say, right, we'll get into this contract, but we will start properly in like 6 weeks or 8 weeks, and we'll try to put a bit of a month or lag between each one. And then some sites have enabling works and demolition work. So every is a key consideration. What you're saying there is just, we look at programs, and we then stack all programs and see what resources needed for each. And a lot of the trades are still subcontracted out, and we still have a good panel of 6-7 key subcontractors for each trade. So there is resource there to deliver them.
To lean on.
It's just when we can start, we don't know.
There's 2 parts in there to running a business. You've got the program and making sure that everything runs as smooth as possible, and then you've also got your own personal or your business cash flow. So you're thinking, well, great, you get 4 jobs on day one. Are you going to stop 2, 3, and 4 from kicking off? Or you're going to try and bring them forward and try and, keep the program as tight as possible. And then it obviously opens you up to more risks if you are having delays on site or someone lets you down. Obviously running scale businesses, which, you and I both do in the loft world, and, you do it in the property game, it is tough when you're trying to take more on because you want it and need it as a business versus trying to slow down. It's almost like if you slow down, you can speed up longer term rather than having a headache and a world of pain.
I wish we slowed down a couple of years ago when we took the full brunt and we was entering into contracts in the high inflation period. That wasn't really a smart business move at the time. But the one good thing it's done for us is that we have captured a lot more of the market share and a lot more of exposure, and a lot. All the clients know us. We're now on frameworks. Clients are coming to us directly with sites. I don't think that would have happened if we did slow down either. So every action has a consequence. And every consequence also has a positive reaction. Sometimes you just can't see it at the time. So it opens different doors. But yeah, from your question there, it's when you scale in a business, the business does eventually turn into a bit of a machine that requires pipeline. Our business requires a pipeline of deals, money, and delivery in terms of the whole chain to deliver. Now, one of the biggest reasons why having 5 sites for us is a problem is because we're land-led and we invest in those sites for the past 2 years. And in our cash flow, we expect the money back, obviously. If we've got some sites in our pipeline that are 60 units, on average for us, it would cost between 3,000 to 5,000 per unit to get through the planning system, to get to site, to get to contract. So if you've got 5 sites with a combined of nearly, could be 200 units, and they've got on average, even if it's $3,000 on the lower end, if it's $3,000, that's 600 grand of our pipeline money sat there that we want back because we're investing in sites now. Literally, I had an email yesterday about another site that we've particularly gone off accepted on. In our pipeline, we're in 2024 now. We're not expecting to start that site until late 2026. That's what we're working on at the moment. But we've got to start investing on a monthly basis. So we've got to put an option fee down, and legal fees are like 30 grand total on that site, knowing that we are not going to start until late 2026 if things go well. That's. It's a capital-intensive business.
What's your average option fee? I mean, obviously, you negotiate down to as little as possible. I mean,
So the standard benchmark for deposits that people always require is 10%. We never pay a 10% deposit unless a site's got full planning. That's the only stage when we get into full deposit zones, really. When a site's got full planning, we're not looking to make any changes because it's going to be a hyper-competitive environment. Other than that, when there's options or conditional contracts where we're taking sites through planning, we'll be trying to get as low as £1 as we can. But most of the time, our average is around 10 grand.
And that gets released to the owner, so just basically can go and spend that, or is it locked away in
Yeah,
escrow? Or,
most of the time it's non-refundable, released to the owner as our bit of commitment. And then what we'll also do though is when we get our offer accepted, we'll get in a pre-app, a scoping pre-app, and we typically try, unless we're really confident, we won't exchange on the site until we've had that scoping pre-app back.
Yeah. So you just sort of just hedging your bets, just kicking it down the road, get through legals, get the pre-app,
All
get some
trying to
positive
risk
advice.
mitigate, mate. As you know, it's all where are the risks? How can we mitigate them? That obviously, pre-apps can, and a lot of the time they do. You can have a positive pre-app and you get to planning and it's negative. So, but it's the only thing you can do really to try to hedge. I'd rather have something than nothing.
Yeah, absolutely. And the last question, one last question, mate, just for your first intro piece of where the hell we're at. Discipline on profit margin. So previously in another life, I tried to set up a electrical company, a plumbing company, a solar company, and trying to integrate all these directors and different minds that wanted to go different ways in their own business. You've also got a lot of heads already reporting to you. When you go into M&E as well as potentially the architectural practice, your groundworks division, there's a lot of heads that report into you, which does take out on you, because you sort of build this business where you demand some energy, and then you've got more people needing some direction or some advice and more board meetings, and you get to a point where it's just too much sometimes. I found anyway when we were trying it. So my question was, the discipline on profit margins, if you're going to have these different divisions, are you going to fix the profit margins in each business, which you sort of have to, or are you going to be able to take a bit of a flex and go, actually, we'll drop that to 7% or 9% to make more money in the development company as and when you need to, because obviously you've got more levers to play around with. So just something to consider.
Yes.
I'm interested in your thoughts.
Yeah. So obviously the divisions are a whole. So two questions there. Actually, I'll answer them both in order. So in terms of like leadership and management, I agree. The companies we've got 50 staff. A portion of that relates to groundworks, a portion of that relates to ops, and then some of that relates to head office. And if you go into a different division, that in itself is going to be more people, right? And management doesn't scare me. In fact, I actually quite like it. I think one of the best parts about building a business is building a big team, as long as it's done efficiently, because what you're building is actually the amount of lives you actually positively impact. And one of the best things from building a successful business is not the money you make, and it's not really it's genuinely, I know it sounds soppy, but it's the contribution you make from your business, and also all of that team that you're building. Like, I'm watching people over the past few years that have started with us and scaled with us, going from effectively like house shares to now having their own house and family and stuff like that. And you're thinking, obviously, they could get jobs elsewhere, but the ecosystem you're facilitating is allowing that, and then giving people like options for training and promotions. It's literally one of the best satisfying things. Working with good people is addictive.
And that sentiment is what's great about participating in the free market. Like, that's our small contribution to the economy and to the greater good, if you like, trying to do positive things that helps people positively. They could get another job elsewhere with someone else also doing positive things, contributing positively. You know what I mean?
Yeah. And you've always got to have in the back of your mind, unfortunately, because I've been in business for a while, right? I've been in business since I was 16, and you people will leave. You've got to build your business to the fact that they could leave you, and it can't be dependent on individuals. But you've got to make them, like Richard Branson says, you've got to invest in them, train them, give them freedom and flexibility, and if make it so good they don't want to leave you, but make them so good that they can leave you. That is a really fine balance. It's a tightrope, and I've definitely not mastered it, but I'm working on it. But to answer your question, Stu, I don't shy away from management or leadership. My leadership style is quite. I will be honest with you all. I've got quite a strong vision. I'm quite very direct in what I expect from people and where I expect the divisions and the business to go. It's quite clear in my mind, and I direct that down, and then I leave them to sort out the broad, finer details. So, like I said, the people I bring in for the groundworks, I set them those KPIs. Said, right, here's the pipeline. This is where I want us to get to, where we can get to. Here's the KPIs I'm looking at, and I'll be monitoring. All the finer details, obviously I'll help you with anything, but the finer details you sort out. And when I come to you when we're off, that's the bit you need to do. You need to find out how we're going to achieve X, Y, and Z, and be on front of it. So when I come and ask you questions, if we're not on it, you've already got the answers of what we need to do. And I've got about 10 direct reports reporting into me, and I manage everybody exactly the same way. I only employ people who directly work for me, A players, and literally the people that work with me, they're really good. Like they just naturally, they get frustrated if things don't go well. They buy into the business. They all agree the KPIs and the objectives. They automatically do it. So when I have meetings with them, it's never like I'm dreading them or anything like that. It's actually more of us. It's kind of like how we chat. It's literally like you're speaking to somebody else about their effectively business that they're running, the division they're running. And we're having chats like this, like where are we off, what do we do? So that was the first part of your question, and then what was the other question? I just started going right into leadership and management.
I totally agree. Firstly, I think that running a business with people you love to be around. I mean, you spend more time with your work colleagues than you do your family, your wife, your kids. So it's definitely important to build that ecosystem that you enjoy being in. And I think the other big difference is that you are folding everything into your vision. Where I think where I was trying to do it, we were trying to take over and expand into different parts of. I was trying to build an electrical firm.
Was you going direct to customers?
Yeah, we were, exactly. So they had their own vision of how they wanted to run it. So it was very difficult to, which, I mean, they all went off and done their own thing in the end, and it was a very small business that we just had dipped our toe in the water, but it was very dismantled. Everyone wanted to go in different directions, so we had to cut that off and just
folding in.
Because we've been offered to do groundworks tenders for other people and stuff like that, and I turn it down because. And I make it clear to the people coming in, this is a subsidiary to serve the main group, and obviously you get the benefit of the group, and the work comes from the group. The group is the client. So ultimately,
here's a scenario. So say your groundworks team have got X amount to turnover per quarter. The development team has got delays, which means they can't get the groundworks. Your head of groundworks is KPI'd on turnover, so wants to go in a direction to hit his own KPIs. And then you stop him from going out externally to hit his KPIs. They're the sort of frictions I'm talking about that can happen where it's just additional stress because their number one thing that you've set them for the year is to do this. And then because of external factors that stop them from doing it means that they want to go another direction because that's what they're set on. And they come up with this great idea and you just cut them down and go, no, we're sticking internally. They're the additional stresses, I think, that could just stack on top of each other in many different companies. It's like,
pipeline's the answer though, isn't it? To the first point.
So,
yeah, but we've got.
you guys have discussed before. The answer to the sound like one of the my investors said to me, just sounds like you need a bigger pipeline. But
it was sticking on a hoodie.
To answer your questions right now, I don't know why I've got a pink pencil, but anyway, it is a consideration. That's why, obviously, before we set the division up, we look at our program, and that's also when you structure the division. You can't structure with everyone perm. You have to have flex in there. You need to have a core base that know that we're always going to be on like 3 sites, for example. So we will gear up for 3 sites. We're always going to be on 3 sites because of just how it all looks. And if the sites blow up to 5, we might service those 2 sites with flexed subcontractors. And then if those sites come off, it's so easy to bring that back down. So you can. It's the same technically with the private sector as well. Because if you're going into the private sector with a minimal pipeline and you're doing it just to hit a turnover KPI, you're gonna then buy a job, and that is not what you should do. So you just don't want to do that. So the premise is that it all comes from the group, which comes from our land. It all and also from clients directly, and then we will structure the divisions with a core gang plus additional flexible subcontracted work, labour resource to go up and down as and when there's these slight delays.
But these slight delays, so you went up. What happens if you're gearing up for 3 and then you can only run 1 site because of planning on multiple sites are delayed, and you've got 6 months, 3 months, and 2 months of backlog?
That is a major, obviously, consideration. We wouldn't have set up the division if we thought that was going to be a risk. So, we didn't set up the division until we've been running years with subcontractors. We're just at a stage now in our pipeline that we've got 3 years of sites ahead of us. So the risk of us being on one site, we've been on 9 sites for the past 15 months, and literally that pipeline, looking at pipeline is something we do on a weekly basis, and we have a very detailed monthly site tracker meeting, where I'm always tracking how many sites we're going to be on and what the resource is going to look like. And touch wood, even with we're just not going to fall below with the amount of sites that we have and all the stages they're at. But below, 8 live sites is where we're not going to fall below for the next 3 years. So apparently, obviously, and that is with push. And it could literally go as high as 16. No, it's not going to go as high as 16. But, so that's our range.
I can fully relate to essentially critical mass is what we're talking about there, being the fundamental pillar to any business. And I can relate to it completely because our business model is similar in a way that it interrelates with different parts of the pipeline, and it's folded in business. It's not like a branched business, it's folded in. And if we don't have sales up here, then construction gets hampered later. So we have to know how many sites do we have to be on as a minimal, and then always aim well above that because of planning delays, bullshit.
Yeah.
So if we're under 5 sites, our prelims get eaten into, and then suddenly we're running, our gross profit margins get eroded, and then we get into sketchy water. So we have to be above that. So we're always aiming for like 10 plus sites at any given time. And I assume that obviously it's the same for you, Dorian, that the key metric and your sole core driver, which is the same for me in my business, is sales. You fundamentally need to know that, not necessarily going out selling, but you need to know that you've got acquisitions coming in and planning, getting secured, and funding from the next
pipeline of deals, pipeline of money, pipeline of delivery. It's just the key things. Simple, we want to bring on sites that achieve our gross margin. We look at our overhead to revenue ratio on a monthly basis. Is it above 5%? We look at our revenue generated per employee, but that skews from a developer's point of view. It skews though when you go into groundworks. You can't really have a huge high revenue per employee in the groundworks division versus what you can as a construction management company, effectively, where you could get like £1 million revenue per employee as a typical construction management company. Whereas if you do
the actual overhead revenue
yourself,
what's that? Your overhead to revenue.
Our overhead to revenue ratio for the main group target is 5% or better, which would be lower
per month, per year.
Just in general, it doesn't matter monthly or year.
Yeah.
So that's that. But if in a subcontractor world, it's more difficult to get like a higher revenue per employee. So that's why the subcontractors you'll see typically have better margins than construction management companies, because they need a higher margin because their revenue is technically lower for the same amount of people.
The absolute sum is smaller, yeah.
I mean, like with 20 employees, you could scale a 20 plus million pound construction management company. With 20 employees, you could probably scale a £4 million groundworks company. That's the difference in scale. So your groundworks margin.
And why do you have
has to be significantly higher?
Sorry, D. Sometimes your connection's lagging out a bit today. Yeah. Why do you have a mini Rubik's cube?
Oh, yeah. Sorry. I sometimes I just solve Rubik's cubes. Basically, I learned to do it, and then
full one, mate. They're even harder.
It's quite
still can't crack the last code.
Full one of you? Yeah.
Flipping hard work.
Yeah, that's the way. Yeah. So it's because
they're like algorithms.
When I'm thinking, I do stuff with. Yeah, when I'm thinking, I do stuff with my hands, and with the 3 Rubik's cube. Once you learn the algorithms, they're quite easy to solve. So now and then, when I'm thinking, I'm just talking in meetings, I'm solving a Rubik's cube at the same time, basically. But only a 3 one though. It's not as intense as Stuart's.
It's more muscle memory then. After the 3 Rubik's cube, you sort of just know the pattern and you can just do it. Yeah, I've forgotten the actual pattern.
Just do it. Yeah.
But you're kinesthetic, I think it's called. So you got obviously people who use their hands and have to. I always touch you. Kinesthetic, I think, is the energy that you use when you need to be doing something with your hands when you're thinking. Does something to your brain. I can't remember what the other 2 are.
Itching, mate. All right, shall we get on to ISG? SG. So we'll talk about this. We'll probably talk about this in the next episode or the one after that as well, just for anyone listening, when we can get Ronan back on the podcast. So give you some context. ISG, huge construction company, major construction company in the UK, have recently gone under. And our good friend Ronan from Ireland used to work for Mace, going back like 5-10 years or whatever, and Mace are also a huge construction company. So when he's next on the podcast, it would be great to dive in with him and see what he thinks, because he's got experience working in that kind of business. But I'll bring it up on stage, so we'll go through the BBC article just for ease. So construction giant collapse sees 2,200 jobs cut, and this is, we're talking about news that's just come out in the last few weeks to a month. And thousands of people have lost their jobs after the UK operations of the international construction giant ISG collapsed into administration. Some 2,200 workers have been made redundant with immediate effect, Joint Administrators EY said in a statement on Friday. The business, owned by the US firm Cathexis, had been struggling financially for some time. Attempts to secure a rescue deal failed, while 200 employees will be kept on to assist the administrators in winding down the business, which holds more than £1 billion worth of government contracts. Apple, Barclays, and Google are also among ISG's private sector clients in the UK. In a widely reported email sent by Chief Executive Zoe Price to all ISG staff on Thursday, she said, "Some of you may have seen reports in the media that ISG has filed for administration here in the UK. With sadness, I can confirm that this is in fact correct. This was not the way that I wanted you to find out, and the news should not have leaked in this way," she added. Miss Price said staff would be paid on Monday as normal, and that the current situation had arisen due to legacy issues relating to large loss-making contracts secured between 2018 and 2020. So this just shows that lagging effect of the construction sector. Obviously, since that time, huge levels of inflation, which we'll go into after. Trading out these projects has had a significant effect on our liquidity. So even though we've been profitable this year, our legacy has led us to a point where we have been unable to continue trading, she wrote. Miss Price had significant efforts. Miss Price said significant efforts had been made to find a buyer for the business, but that these had been unsuccessful. EY also said on Friday that no potential buyers that had come forward were able to show they had enough money to finance the operations and keep them afloat in the future. And then last bit, we wish to be clear to employees, suppliers, and customers that it was not possible to conclude a sales at the potential purchaser. A sale, as the potential purchaser could not, despite repeated requests of them to do so, adequately demonstrate that they had the funding needed to recapitalize the business and keep it solvent, they said. The 8 arms of ISG's UK business, including its engineering and retail branches, have all been placed in administration. The group, which was in the middle of the work on numerous government contracts, has made the majority of its 2,400 UK employees redundant with immediate effect, and work on all projects has stopped. ISG is involved in 69 government projects totaling more than £1 billion, including work on prison refurbishments of the Ministry of Justice, according to data analyst Barber ABI. It has also made the velodrome of the 2012 London Olympics. Barber ABI's chief analyst Ed Griffiths said the live projects, including a £300 million extension to the Grendon and Spring Hill prisons in Buckinghamshire, were just at the tip of the iceberg. The ripple effect will be extremely worrying for the hundreds of subcontractors involved, so all that collateral damage as well. But a government spokesperson said it had already implemented detailed contingency plans, and affected departments were working to ensure sites were safe and secure. So that's the end of the BBC article. I've done some extra digging as well just to understand a little bit more here, but to be honest, through intuition, we can probably divulge what's likely happened behind the scenes, at least financially, for them to get to this point. But I just want to add that I can relate to this massively, because our construction business was built in the fire of high levels of inflation, and we built it. We had to start it because a contractor that was on our big site went bust, so we started it in that process. And that legacy issue from that site, finding the money and funding that, holding that debt, which we then had to pay off over the last year and a half, is an absolute beast. It's like a tumor on the side of your business that you're constantly feeling the brunt of every fucking week, and you're just like, but slowly you chip it away, and gradually we've managed to dilute the problem, and it's away from our cash flow issues now.
Fight another day.
Live to fight another day, but obviously
it's the number one reason why these businesses have gone under, because they've been fighting since 2021 onwards, and we're bringing in new jobs and stuff like that. But I don't think people that are not in the sector realise how big the inflation problem was in the construction space. Like, it was massive. I mean, the jobs. Like, I'll give you an example. Like, we did a job recent. We signed a job a couple of years ago, based, and that cost data was out of date, unfortunately. 15 apartments for £2 million, basically, and obviously these are really, really high spec, large apartments, all that sort of stuff. In today's world, that was land inclusive as well in terms of the sales price. In today's world, that same site is 3.2 million. So, in the space of a few years, for it to go up 1.2 million on only a £2 million project is just phenomenal. It's like no one is on margins like that in the sector.
It's fucking mental, and it's to give you an idea. I mean, the problem we had was about a 300 grand problem, and the only way out was to trade your way out. So you're trading your way out by securing new fixed price contracts to then be able to make more surplus to help ease the cash flow pains of the past. But then you could be in an inflationary environment, you could be tying yourself into more mini problems, and it's damage limitation and diversification of those contracts. And because we do HMOs predominantly, they're short term, so our exposure to the inflation wasn't as bad. But if we'd rolled straight into other bigger sites with inflation staying the way it was, we couldn't have done fixed price. We'd have had to gone like cost plus. It would have just been a fucking ball ache.
And that's why understanding your costs are so important, because we had timber increase like month on month for like 4 months solid, went up like quadrupled in price over 4 months, and tracking these costs, like cement went up for the roof, plaster, gypsum products. So if you don't know your costs,
insulation went
through the roof. Yeah, I mean that tripled, I think, or doubled in price. So by tracking your costs on a month by month basis is so important, especially as a small business. And it's the other builders and developers who don't, and they just assume the prices used to cost X, so they go and sell 5 or 6 projects at X, and then they start using that cash to finish previous projects. And this spiral of decline is the biggest fatality of most businesses. No one goes into business to, well, not an awful lot of them do, but not everyone goes in with the intention of trying to, of going bust. It's just one of those things that if you're not organised as a small business, you're fucked.
Yeah. And even though not even a small business, and I agree with you, Stuart, but you were having, and we experienced this first time, really experienced QSs, managing QSs, commercial managers, not seeing it, basically, not getting ahead of the curve and coming up with risk management to be like, look, we just shouldn't be doing any jobs. Like, really stop everything, because this is nuts. And that's why also it just kept going, really. And we obviously traded through, and I was also taking on new contracts through. So you can see it with ours. You can see a trend from loss-making jobs to break-even jobs to lower margin jobs to back to reasonable margin. You can see it over a timeline, because we just plowed straight through. And like I mentioned, in hindsight, not a good business move. And unless you've got capital behind you.
You say that though, D, but that's the choice we had to make as well. And I much prefer that now, only with hindsight, that we did that rather than come to a halt, stop, maybe layoffs, and like stabilize, and then hope the market will get better in some period. I think you do have to take that risk, don't you, as a business? Do you want to keep growing? Do you want to try and trade your way out of it? Or do you want to stagnate, recapitalize?
I mean, every business will tell you that there's good times and bad times, and you can never time the market. This is like with hindsight. Hindsight's the wonderful thing, isn't it? Like, everyone will be billionaires in hindsight. But you're right. I think you are right. Obviously, I'm just talking with the benefit of hindsight. But in reality, and day to day, like going forward, I don't know what's going to happen in the next 12 months, especially with current wars going on. Neither do you guys. But we're still trading. We're still taking on jobs. We could literally be walking into the exact same trap. But the only things we're doing now is Obviously, we're having a lot more conversations with clients. We're trying to get flexible terms in contracts, is risk management. We're keeping as much capital in the business, trying to obviously deleverage bad debt as much as you can, not pulling cash out of the business and putting into longer terms, using other people's money, doing more fundraising, basically being a lot more liquid and solid, trying to be anyway, and getting margins higher,
I've,
for that
I've,
and for that benefit. Like,
I've got a question for you two, who've been in construction longer than I have. What would you do? Let's say the issue in Israel at the moment escalates and we end up in some fucking dire situation again. Interest rates, inflation might rise. If you're in these contracts, is there a way, particularly for you, Dorian, where you could secure fixed price with a contingent, with a condition subject to certain metrics in the CPI or RPI, whichever you want to link it to, where you then pivot the contract to a cost plus from thereafter, so that you
it's
protect
called
your downside?
it's called a fluctuation provision, and they come in. We can get them on longer jobs, which are jobs that are going to last for a lot longer than 2 years. But any job that's classed as a short-term job, which is less than 2 years, then the stance at the moment across housing associations really is, and local authorities, is it's a fixed price. And
But do you think?
we're
But do you think that?
campaigning to be like, look, it's go on.
No, I think you were going to answer my question like that. You were campaigning to say the barometer that used to measure the 2 years based on historical CPI or inflation data is no longer relevant at a time where there's such volatility.
Yeah,
And
yeah. Yeah. So like we are pushing for more collaborative procurement because the government's not really going to get value for money, putting all the risk on contractors, especially when so many have now gone bust and there's only a few really left. And also people getting into the sector like, why would I do that? So
yeah,
they should more collaborative procurement is definitely what we're pushing for. That we the odd housing association does a cost plus now and then, but for us in this sector, the reason why collaborative procurement doesn't happen is because the grant system to lock in a site gets crystallized at such an early stage. So if they say 30 units there, it's going to cost you 6 million. They go to the government and be like, we need 4 million as a grant because it's social housing. So obviously the rent's really low. So we need 4 million as a grant. We'll plug the 2 million. That gives us our return over 50 years, 50, 60 years. That's what we need. Okay, that's locked in. That 4 million now gets crystallized. If that goes from 6 million to 7 million, their contribution goes from 2 million to 3 million, and they can't do it, basically. So until it has to come all the way from the top, where the top is like, right, we'll guarantee you 6 million, and then we'll have some kind of flex provision for another 10% if inflation goes up. And then that can then come back through then the contracts because the risk now isn't sat with a not-for-profit housing association. Does that make sense?
yeah. And just to revert back to IS. Well, actually, not just before we revert back to ISG. Do you think then that because of the experience of the past few years, we're going to see more contractors trying to do the same thing, Dorian, and trying to campaign to say, look, this traditional 2-year period where considered short term is no longer short term because of the volatility in the political climate, economic climate, wars, things like that. So more fluctuation conditions are going to be applied and attributed to these contracts to ensure that contractors stay in business, because it's so fundamental to have cost assurity, isn't it, in the construction
Yeah.
sector?
So two things on that. One is the short answer is yes. You see some now. It's just not everyone's adopting it. That will have fluctuation provisions in. So basically, the price will then be linked to an index, which is typically going to be the BCIS or all price index, and they'll say for the first 5% we'll deal with as a contractor. That's the risk we take. Anything above that, they're going to step back. They're going to step in and contribute towards that, up to then a top level where it becomes classed as unprecedented, and everyone needs government assistance again, basically. So that's what it's the trend is going towards. And then the other thing really as well is what we're looking at too is actually more collaborative JVs with clients, not housing associations, but also funds as well, where you go into the private market a bit, and it's they take the risk with you in exchange for profit share. It's like a JV type relationship. So they'll fund it all, so we don't have the funding risk. We'll deliver it and get cash flow too. And yes, we've still got cost price inflation, but the one thing that happened during the cost price inflation is that sale prices also rose. Our problem is that, contracts don't rise in price. So it's a combination, really. But yeah, the biggest one by far was managing the cost risk in the contract.
And that's what gives you strength, right? As a developer contractor, which is the same for all three of us here, really, that there are at least two margins to subsidize yourself from. Because in times of inflation, doesn't mean, there's a lagging effect. So it's not an immediate cash flow solution by any means. But times of inflation, bad for a construction company, good for holding assets.
Yeah. Or if you were good in the investment markets, you could hedge by doing futures. So, but that is obviously going to be for the very small amount of construction companies are going to be doing future contracts on timber if they start getting waves. And obviously that is very speculative as well. So.
What about you, Stu, with getting onto these bigger projects? I know that they're yours as well with joint venture partners, things like that.
Yeah, I mean, well, to be honest, why we build up our database and tables, our plan is, we've always done a cost plus open book with a margin that was agreed up front. So we can sort of hedge that risk to make sure that we're not losing out. I think that it's really unfair for, construction is already a high risk game to play anyway. You're already taking so many risks with the unknown of, you don't know what it's going to cost until you build it. So you take a load of risk on, and then to throw in a load of volatility and a load of, inflation and a load of things that are outside, the act of war and floods and storm. And, Jim, good friend of ours, he's got a site of 5 bungalows at the moment, completely waterlogged. He just put down new turf and it's completely fucked. All these risks, we have to work with being outside anyway. I just think it's just so unfair that, these wild swings that are made outside of your control, you take all the risk and then go bust on the back of your hard work. So yeah, we just try and eliminate it by doing open book, so ultimately the construction business that does work to a very small margin doesn't lose out. We do what we can, and ultimately it will affect the development margin. But as we collect all the data and we understand all these costs and all these risks, eventually our plan is to go into a fixed price contract with our SPV or investment partners, just so they have a bit more security on what margins we're going to make. But ultimately, we're giving quite a lot of equity away in those deals at the moment. So we try and be fair on both sides of the coin.
It's significantly more weatherproof, significantly more on a cost plus basis like you're doing, where you can erode the margin on the development so long as the retention of the asset stays viable for, at a considerable stress test. Because you could then accept as a group in that scenario, as a blended contractor and developer, that parking money in the asset and getting maybe a slightly lower yield is a significantly better outcome than contractor go bust and now need to find new contractor, holding costs, interest on the development also get hampered, could get called in. So it gives you a lot more security if you've got that contractor and developer blend. And that's probably what we're going to see. To Dorian's point, is that you're going to have many more hybrid scenarios going on, whether that's joint ventures or equity participation, or just in general developer contractors doing far better than traditional contractors because they just can't compete in an environment of volatility. It's not possible.
Well, there's two parts there. So the first thing is we actually look for investors who actually want to park their cash in property. Our job's to recycle as much or all of their money back out so they can go again. And obviously that's then when the addiction and the drug, if they're getting half of a building or 40% of a building that's, they've invested in, they got most of their money back out and they can go again. That's good. And then the other part is making sure we protect the construction company, because we're not going into business to lose the construction company. We're using it as a tool to make sure we're building as cost competitively as possible. If we can build at 15-20% less than what other people can build at, because we're willing to take a hit on the profit we're making as a construction business, that's another great legacy or another great asset that we provide as a developer builder to these deals. So we can get in, we can make a very fine margin to make sure we cover overhead, but ultimately we're almost to make sure the development has the best chance possible. Or it also means we can offer that a little bit more than other developers, because we're willing to take a hit on the profits that the construction company doesn't necessarily need, as long as it can stay afloat and keep adding assets. It's buying and holding property. I already see the long-term growth, and that sort of hedges you against all these inflation, all these things that's outside of our control. by having an equity stack or having a liquid that you can lean on, which is where I choose to keep any business assets now in Strike, which is through the business in Bitcoin, because I think that is the only thing that can hedge against these wild swings. Yes, it's volatile, but it's volatile to the upside. And so as long as you don't need it for 6 months to a year, hold any profits or any equity, any capital reserves in that. And then obviously on the other side, hold these properties that will, when they print a load of money and house prices go up, that's not the house increasing in size or any value. That's just a denomination of the amount of pounds that can afford to buy the property. And then obviously having the working capital there. So it's having a hedge on all these things. So we're trying to make sure that if the market does turn, we've got something. I believe that Bitcoin's a flight to quality or flight to safety. So if they really go crazy and wars kick off and the world's going to pot, a lot of money or equity or capital will go into Bitcoin, which means I can pull some of that out to make sure that in the fiat world or in the world we're all living in, I've got some money there to make sure I can get myself out of jail free effectively. So just having this macro opinion of where the world could go, and then making sure I'm in the best position to firefight and stay afloat and stay in business really.
And then just reverting back to the ISG, something interesting actually, if you guys may remember, I can't remember the exact detail, but we actually spoke maybe the third, fourth or fifth episode or something. And we spoke about, the consequence of inflation and interest rates and the damage to businesses and the property sector. We actually, at the time, I think we were looking at, a multitude of companies that were having issues. And we were talking about what about the companies that we don't know yet, the companies that have issues that you just don't know about. And clearly ISG was one of them. And, was it Carillion? Carillion, and who was the other one? Henry. Was it Henry? Henry had a big collapse as well. So there's these things happening
Man,
that
they happen
and
all the time.
Buckingham Group as well.
Buckingham Group. Yeah. So there's these major issues, systemic issues in these large businesses. These are big businesses as well. These aren't like our business. And I'm not saying, our businesses are tiny. We are in our local markets.
We're dropping the ocean.
But we are dropping the ocean compared to these behemoths that are around the country doing billion-pound contracts. For them to go down, the supply chain and the impact of subcontracts and things like that. I mean, Henry, I'm pretty sure, nearly took out the insurance market. Like, they were so highly geared, and we're seeing more of these. And because of what's happened over the last 4 years, they're all having similar systemic issues of legacy problems. And I guarantee by the time the year's out, there'll probably be another big one. And next year there'll probably be another one.
It's a domino effect. So if you've got they had 2,200 workers, right? They were all on probably 90, 120 day terms. So they've all cash flow their small businesses to make sure that this money is almost guaranteed coming in from this big government, basically government backed company. Go on, Dee.
Yeah, because I think the largest, some of the subcontractors you're going to see mine losing money it's going to be in the millions. I think one subcontractor's already been identified as a £15 million hit. Like, that is, imagine, just struggle to come back from stuff like that, really, wouldn't you? Depending obviously on the size of you, but I mean, like,
you can't. You get all written off. All the debt.
Yeah, it gets written off. Like, it's risky, very risky. So, I mean, if anybody's listening and you're looking to get into construction, I suppose, what's the advice that we would give them? I think there's two. What if those want to get into construction, or those want to be a subcontractor for a main contractor? What advice would you give them?
I would say, honestly, I would genuinely say, particularly for construction, development is different. Development is different because I think it's an absolute must if you want to build wealth. But construction, if you want to start a construction business, even though it's annoying, I have to add this nuance, but the nuance is if you want to be a good developer nowadays, you should having exposure to the construction gives you more control, mitigates more risk. But just starting a construction business in general, the advice should be, and I'm stealing this from either Steve Jobs or Elon Musk or whoever it is, but is don't do it. That if you need any encouragement to start a construction business, you don't have the fucking bottle to take on the business and do it. And I'm that guy who is naive enough to do it because I had no construction experience when starting a construction company. And I was like, how difficult can it really be? Like, how everything's solvable, but fuck me, the litany of issues in a construction business compared to any other business. Like, Maybe
Yes,
advanced
tough.
manufacturing. Advanced manufacturing. There are industrial businesses that, yes, are very difficult. Car manufacturer is a harder business, I'd probably say, on balance, than a construction company. But a construction company is one of the hardest businesses. So if you needed encouragement to start one, then you're not going to make it through the last 4 years we've just had, and probably what the next 4 years looks like as well. That'd be my genuine advice. I genuinely would say that. What used to.
I would say diversification and stick to a niche, because it's so alluring to be able to do anything in construction. And 1 minute you're doing groundworks, then you're pitching a roof, and then you're dealing with M&E, and then you're dealing with all sorts of stuff, which you can chase the money thinking there's more margin. The grass is always greener in another area. But actually, if you just focus on one type of construction and then become a master of that, secure some sort of pipeline and some profits, because there's so many systems. And the reason I went from loft conversions for 10 years, 5 years into general construction, and then back into lofts was, when you're in general construction, it's like a bath with too many holes. It bleeds cash everywhere. And there's tens of thousands of systems to try and fix, where you might as well take one part of the construction process and nail it and fix the 1,500 problems you need to fix first. Try and give yourself some stability and then add on to it. These big government contracts, I think that, if I was working for one of the big house builders, and there's the security of pipe work there, you can almost get pulled into, this is almost guaranteed money. But then if they pull that credit line, or don't pay you for the last 3 months you've been working for them, because you thought in your mind this was a safe hedge, that can pull your whole business down, which then ruins your relationship. It ruins your relationship with your suppliers, your contractors. It's just an unraveling of shit, which, like I said, these companies don't go into business to fail. But when you've got such a big pipeline, like you're saying right at the start, you need a bigger pipeline. If you've got a problem with your pipeline, the one thing we've all said is you would sell more to keep going. And I think that's all that ISG would have done, is they would have gone, shit, we've got these big problems. And that happened right over the COVID period from 18 to 21 was their big problems. So they've gone all these fixed price contracts. We know government contracts, they push, they go with the lowest deal there is. There'll be loads of contracts in place for them to add variations to order and to try and make their profits later on. But if the governments are either pulling or fixing contracts during that period, you can just see this compression of problems that's going to happen. And undervaluations, that's what I think another issue was. Undervaluations with no profit is the death of most businesses. So the knock-on effect is huge. And I just feel sorry for the smaller contractors who have built their whole livelihood around servicing ISG, and for the tap to be turned off.
But it's an important business, like 101, isn't it? Do not have too much reliance on one contractor. You shouldn't have 80% of your revenue coming from one client, right? So you should always have diversification, which is where Dorian's model, my model, your model, Stu, you got lofts, he's got house bashing, I got HMOs. We're diversified. We're not going one client's doing 80%, 20% diversified.
Technically, we are not that diversified, even though we are across clients and we don't have anyone. I follow that. They're all backed by Welsh government. Our client ultimately, indirectly, that invisible hand is Welsh government.
They're at least the most unlikely to go bust, as far as a
with a flick. If Welsh government go bust, we have a serious problem.
We've got a bigger problem.
It's not going to just impact us; it'll impact everyone, schools, hospitals, everything.
If they drop the grant by 50%, that would have a massive knock-on effect. They said, right, we now can't afford. That's the huge risk. Or they go, right, we need to put a temporary stop on this for 3 years. Then that's a huge risk that's again outside of your control. Then Dorian goes into doing pavements and landscaping and driveways.
Well, no, I mean, but you're right. I mean, that was when I do our risk register. It was up there as the number 5 in terms of the biggest impact, but also quite low in terms of likely. Well, ultimately, if they stop supporting new social housing or affordable housing development, because it is subsidised. It's a subsidised industry. So all it takes is a flick of a signature. Now, ignoring all the repercussions around that. And obviously, anyone you speak to, they say it's so unlikely that they would do that because they're just so behind and they need to. But ultimately, the theory is they can do that. And if you play out that model, then it's very difficult to do sites. The one good thing that the business does have is it has a 3-year look ahead, and grant is allocated 3 years in advance. So we all know what's going to happen for the next couple of years. So it wouldn't hit you straight away. Any sites in your pipeline that are already agreed would still go ahead. So it'd give you some time to, sort them out and things like that. But, that's why in the future, you do need, we want to diversify in the future, and we want to go into other sectors like care and later living and even private. You'll do that will be later on, and forward sold PRS stuff to institutional funds, private lend, which has also can go up and down in terms of the tap can go off or on. But I think you will have to get to a stage in business where you know where the risk is, and you'll have to decide whether you're going to take that risk. And effectively, they say that you should never bet the house. You take your risks, like Jeff Bezos says it. If there's a door that you can go through and you come back out, just take the risk. Don't worry about it too much. If there's a door you go through and you can't come back from it, then you have to be very, very confident that you've done everything you can to de-risk it. And that's really where the stage we got to is. You look at the social and affordable housing trend. You look at the money they're putting into it. You're looking at all the political parties' manifestos, and it didn't really matter who got in. They all had manifestos on social housing, affordable housing. So you take a calculated decision. You'd be like, the likelihood for this term and next parliament term is low risk. So I'm going to go through that door and just nail it for the next 5 years, basically.
That's the importance, Dee. What you're touching on is the importance of knowing your market, which is where, if you are naive stepping into any new sector or market, which I know firsthand, if you don't know that market like the experienced ones do, then you don't know what you don't know, and things can burn you in a way that you go, how the fuck did we not see that coming? Whereas, the existing players in the market, they've seen it before, and it's knowing your market so important.
Definitely. And Stuart was right earlier when he said something. Yeah, Stuart was right really when he said something earlier. Every job that we've done where we've used a brand new build methodology, our margin has been terrible. The extra costs have been phenomenal. Stuff we just don't know, we didn't know. Even with an experienced team, until you go through something for the first time, you just don't know how much it's going to cost, basically. And you have to collect that data, the hits on the program, what the actual real critical paths are, and design issues, etc. So once you've gone through something and you found a system that works, you make the most money by replicating that system and standardizing and systemizing and just building your business, rather than trying to, as Stuart mentioned, jump from so many different things too quickly, because there's actually a huge amount of risk in that. You just don't know. You just don't know all the different stuff that's going to come up.
If you overexpose, if you're overexposed and try to take on too much because shiny penny syndrome, or because you have to as a business to try and diversify, you really need to set out what you're trying to get out of it and then build the whole business around it. I'm just thinking if ISG were my customer, go on.
Yeah. No, I was just going to say about build methodologies or anything new is like we're geared up to do 10 live sites simultaneously. 8 of those sites are going to be panelized timber frame systems. Basically, that's where it's going to be, and we will do everything we can to make sure that happens. If we're going to use a new methodology like a light gauge steel system or a precast concrete system or a modular system or an ICF system, until we've kind of gone through that, we'll only do it on one site, knowing that the risk of costs blowing up is high. And until we've gone through that and we've collected all the data and we've learned from it, would we look to roll it out in more sites than once?
It makes a lot of sense. I was just going to say, the ISG, if they were my customer, it's amazing how much you can hide in a P&L, and you can look at their, quarterly reviews and their monthly statements and stuff, and you can try and understand where they're going as a business. But it's all smoke and mirrors until the actual curtain comes down, then they go pop. It's very difficult to know if they're going to go bust or not. I'm just trying to think what else I would do if I was, if I had all my eggs in them as a company. What could you do to try and sort of preempt or see this coming? How would you try and?
So if I was a subcontractor, and I was going to start working for main contractors, the likelihood is you're not going to be on fast payment terms, more than likely. If I was a niche specialist subcontractor that could command things like deposits, like lift companies, for example, very specialist, then it's different. But if you're talking about a main subcontractor where there's lots of competition, you're not probably going to get good payment terms. You're going to be on like 45, 60 days, pretty much. So what I would do is when I've geared up the business model, I would build in I would structure things like invoice discounting and factoring within my business model, and the cost of that within my tender price. And I would also try to work for main contractors that I could get some kind of, my factoring company would provide debt guarantee insurance for. And even if it means I make a slightly lower margin, those are the two main ways to mitigate against cash flow risk and insolvencies. It's by working for companies that you can get factoring for, and that you can also get bad debt guarantee insurance for. If you can't get guarantee insurance for those companies, then the writing is kind of a little bit on the wall, or they may, but up to a certain level. That's where it comes back down to sales and pipelines. You've got to be really strict with yourself. Be like, I can only do 1 or 2 jobs for that company. I'll maybe go slightly above my limit and take that risk. But my focus, my sales manager's focus is getting contracts from everyone else now that meet those criteria. I can get factoring on them, and my price gets accepted with the cost of factoring within them, and I can also get bad debt guarantee insurance on them. And I can do 1 or 2 or maybe even 3 contracts for each one, and then hopefully build a business with 10 contracts across 5 clients. All of them are insured. So if they do go wrong,
you're covered
as
a business.
it's not going to take me down.
I'd also say and this is kind of for any business, but particularly, capital intensives, long payment terms, you're holding cash and things like that. It's important to understand the idea of a treasury for your business. The same way our government has to do, the same way big corporates do, and pension funds and things like that. The last few years is testament to what can happen in a market where you have cash flow squeeze and contraction and things like that. So it's important to either hold more cash than you think you'll need, or have some reserves in longer term things. Bitcoin, although it is liquid, so that is kind of short term, but even if it's buying up some commercial assets and contributing to your pension and other things like that can also, maybe it's just, as a business, you need to think, okay, we want to grow really quick, but if we're going to do that, we're taking out all this exposure and all this risk, and this is for any business, then you should have some kind of diversification, a cushion, a backstop, a strength to your business that ensures that if you do need to cash flow for whatever reason, a 2-3 month period where you may have issues with some main contractors paying up, then you can in any event keep your business moving forwards. And I'm sure you guys have experienced it at some point where you might have sold buy-to-let assets to fund growth in your business because that was a part of your treasury. You had this equity in them making, maybe a measly yield compared to what your business does. So therefore it makes sense to sell the equity, recapitalize the business so it can keep moving and making more money than the buy-to-let could, which is just an example.
I'm actually going through that right now. So I bought a property in 2008. Go on, Lee. I was going to say, I'm just buying a property. I'm sorry, I'm just selling a property in Virginia Water that I bought in 2007. And I've just buy-to-let held it. But because obviously the changes happen where it's now classed as some of my income, it restricts me from actually paying myself a salary through different businesses. I think, to touch on what Rye said, having other businesses that all feed in, so you don't have to rely on one business to pay yourself, or to pay as little out as possible to you personally to live. And the reason I'm selling this house is it makes sense to release maybe up to 200 grand that I've got to pay some capital gains on, but it actually stops the 23 grand a year of income that's classed as my income. So I can then pay myself the 23 grand, keep myself in the same position, but pay some capital gains, give myself some extra liquid for me to do other things with, or to invest in other businesses. But yeah, the point was, don't just rely on one sole business to pay you your whole lifestyle, and keep it shrewd, keep it frugal as much as possible, and don't live a fancy lifestyle. Because if your business does need, a 2-3 month hole, you need to a great book's profit first. It's just basically siphon out through the good times a little bit of cash into a separate account, and then when the bad times come and you need to fill a hole, and give yourself, just only you can touch it. So your funding lines or your accounts team have to ask you to pull some money out, and then it will just open up a load of reasons why they're doing it. Normally it's around big VAT periods, or or we've taken a big project on and we've got a 50 grand hole to fill. There'll be a reason for it, and then we can learn from it and change our systems. And you've always constantly got to think about the worst case scenarios and fight, save for the rainy days as well. Go on,
but even more so than, sorry, D, just even more so than pre-pandemic, where we experienced the macro climate of cheap borrowing, abundance of capital in the markets, and there was such a bullish mentality in all sectors, driven particularly by the tech sector and VC appetite, and that sort of bled out everywhere, and everyone was just aggressive. Really, that was an unusual market. That was unusual for that level of stimulus, that level of conviction from investors, the market, the government in general. Pandemic comes in, and we won't dive into all the bullshit around that and government intervention and things like that, but that then kind of was a big wake up call. And now we're in a market that's really much more typical. This is kind of like more typical if you just look historically, and it's much more difficult. But that's kind of how business should be. We shouldn't just have free, easy money everywhere where everyone's growth. It should be, you have to diversify. You have to have a stable asset base backing your business. You have to have diversification in your revenue streams. Those are typical business practices experienced in the 70s, 80s, and 90s to get them through those times. We've just experienced something that we think is seemingly unusual for the last 4 years, but really it was the 10 years before that, between the 2008 crisis and the pandemic.
Free money.
That was the unusual period. Yeah. And it's free money that did it, just coming back to the fiat system and Bitcoin. But it was that market that distorted market consensus and expectations. And then that led to this big, well, that is what a bubble is, isn't it? It just leads to a bubble, and then it all comes shitting down when COVID happens. But sorry, D, I just had to rant on that.
No, I was just going to build on for 2 points. One, just, Stuart and everyone listening, capital gains obviously is a thing, but I don't know if in your portfolio of investments, remember as well that you could potentially reinvest into EIS or SCIS qualifying businesses. I know it may not be at the right stage for you, but in the future, people that do create a capital gain, they can invest into SCIS type businesses, and 50% of your gain is then exempt from capital gains, and you can also defer.
What if you sell a property in your own name and then invest?
If you generate a capital gain and you invest into EIS or SCIS qualifying businesses, there's like some exemptions and deferments you can get for capital gains tax. So just FYI, it might not be at the right stage. You might want to put that money to better things, but you'll see investors do that a lot. Is if they make a capital gain, they put it into SCIS qualifying businesses. 50% of the gain is exempt, and then they get to go again and all that sort of stuff and defer. But the what I was saying earlier though was, even what you was talking about with cash there, Ryan, even if I had cash flow coming in as a subcontractor, I would still, in my business model, look to be operating with, kind of debtor book leveraging and guarantees as best as I could. Because like we as a main contractor, we have some subcontractors that do that. And like we'll get a letter from HSBC after we've issued the invoice, be like, you're paying us, you owe us the debt because we have the factoring facility. So it's a bit different from a main contractor going against a subcontractor versus HSBC, if you know what I mean. Do you know what I mean? So it's
definitely. I think
there's a big balance though between keeping too much cash not working for you and trying to grow and scale a business. And it's, where does that line come? Like, how much cash do you need to get yourself out of a hole, and how much cash are you putting aside where it's not actually working for you and not allowing you to take another member of staff?
If you're at a stage where you've got too much cash, which is not many businesses get to that stage for quite a while. But if you're listening to this and you're at the stage where you've got too much cash, then you've got a problem that most people want.
But it's an interesting point though, because that is kind of been the moving target, hasn't it, over the last 4 years? Is people trying to find that security buffer, like how much do I need in this new kind of environment of rates staying particularly sticky. They will come down, but we're not going to feel that for a while. Inflation likely to return, and we're still feeling the fallout of that. And a general sentiment in the market where buyer appetite is reduced, and there's a bit more limiting, and particularly for contractors, for where they can turn to. It's never been, I don't think, drier for construction, particularly in certain parts of construction. So it is important to know, what is that bottom line? Like, what should I be holding as cash? What's a sensible amount now compared to pre-pandemic levels, where there's just a lot of work on the table?
Do you have metrics for that? Do you say, like, I want 1 month's revenue or 1 month's operating costs, or 3 months operating costs? How do you do it?
Yeah, we spoke about this recently, going back maybe I don't know, 4 or 5 weeks ago, and I think all four of us, including Jack, spoke about what we should be holding compared to what we actually hold because of aggressive, reinvestment and forward funding motivations that we all have to keep growing the business. But I mean, yeah, it's something where me and Robbie actually are doing a sit down this Thursday because we've gone through a growth period, hired a lot more staff, and we want to just reassess the different trading businesses and see where's that new critical mass, like where do we need to be. But we're always, for us, it's how many sites are we securing each month in the sourcing business, sourcing acquisitions, however many deals that secures, and then looking at the duration until we're on site with those in the construction. That's our barometer. And at the moment, we know that 2 a month keeps us solvent. And any more, it's then working with those growth parameters to see like how much are we chewing into those overheads, how much are they chewing into our margin. So we look at it like that. How many deals do we sell a month? And that feeds into the rest of the business. So that's how we sort of look at it. But I know that's not that usual. We should probably be holding 3 months worth of wages and overheads, but I don't think anyone's doing that right now in this market.
No one can afford to at the moment.
What about you guys? Yeah.
I'm keeping around. Well, it depends on. I can get access to more money if I need to, but the company generally holds around about 100 to 120 grand's worth of working as agile shit. We need a hole to fill sort of cash. We could do with double that, to be honest, at times, but ultimately that can go down as low as sort of 30 grand, and it can go up to about 200 grand. So we sort of, and it depends on what risks we're taking on. If we're taking on a new big project, then we want that to be a little bit more toppy. And if we've just come out of a big job, then we'll maybe slow it down for 3 or 4 months and just let that sort of regain. But we put about 5 grand a week into a separate holding account, which just builds up over time, and then you might not need it for 9 weeks, and then you go in there and pull out 30 grand for whatever hole you need to. But that's just the running of a small business, really. You just need to have cash around you, because cash will kill any business.
You have just touched again on that treasury point, though, that you can access more cash if you needed to. If you needed to, you could sell some Bitcoin.
Oh yeah.
You could sell the buy-to-let. You could get, you get a bridge against an asset or something. You could find capital if you needed to. That's the whole point of that treasury aspect, that small businesses particularly need to be aware of cash flow constraints, because you don't have the benefit of
but we don't use any debt, so we've got no overdrafts, we've got no, we're not using Funding Circle or HSBC or anything. But we could pick up the phone to the business account and say, we've got a pipeline, this is where we're at, and within a week we could get access to a few hundred grand. They've just brought out a new COVID grant, I can't remember what it's called. I've got a slide here somewhere. But they've got a new grant out, which basically, even if you took out a grant during COVID, they've now extended it for another 4 years, which is just another way of them being able to print more money in an area. But if companies are struggling, there is, where is it? Can't remember the name of the next term they've made of this new loan. It'll come back to me in a sec. But ultimately, if you are needing extra cash, then this is another lever that you can pull.
I'll add to that, Stu, whilst you're on that point there. There's credit cards, there's Amex cards, there's things like that. But there's also, and this is not financial advice in any way, and this is not me advertising for these companies, but we use a company called Iowoka Capital, and you can tap into short-term finance same day.
Very pricey. Very pricey.
It's expensive. It's expensive, but it gets cheaper the more you borrow.
It depends how you look at it, because it depends how you look at it, because there's no arrangement fee and no exit fee. So if there's no arrangement fee and no exit fees, and it's genuinely is short term, then the actual cost, like there is a place in the market for things like that. It's not that bad. Your problem is when you stick on it for a while and you turn it into a term facility, then you compare it then with real cost of capital for an annual, unsecured business loans now, and you do it anyway, are like 24% per annum. That's really where unsecured business loans are at the moment, unless you've got a strong balance sheet. If you've got assets, obviously it comes all the way down, but cost of financing is expensive. So
this
but
new loan than your business going bust.
You guys heard of the GGS loan?
No.
It's the growth guarantee
government
scheme.
Growth guarantee.
Yeah, that's it. So you can basically borrow against a government-backed loan, which most lenders will lend against, and you can take it out even if you've gone.
They say that, but the lenders still underwrite it as a standard business loan. So it's actually quite difficult to get it.
Right. Okay. I've been told the opposite. I've been told it's quite straightforward, a bit like the the COVID loans. If you've taken out £250,000 unsecured, you now have to. It's now personally guaranteed rather than it being backed by the government. But I think the lender is backed. But I've not done enough research into it. Not that we need it, but it's there. If again, you're always looking for new funding lines in business to make sure you can, especially in development where you have got big numbers.
Yeah, I'm looking at funding every day. I think one of the key arts to being successful in the property development space is that's really, it comes back down to generating sales, which is deals and raising money. Like you cannot scale a development business without and then being able to execute. You just cannot do it without all points of that triangle. Nothing to any reasonable size anyway. I mean, you could obviously do with your own capital if you wanted to a deal a year, but it's not really
I couldn't agree
development
more,
business.
Yeah, couldn't agree more. You need to know where are more potential credit lines for short-term capital, as well as diversifying your asset base, as well as diversifying your client base, as well as bringing in more sales. That's your job as a business owner. That's your responsibility, right?
And when you see some of these, and you see some of these like people connected, in the finance space, corporate finance world, and they could just go out and open, like a SPAC company, a special purpose acquisition company, raise tens of millions and go out and start an M&A strategy, or like I said, if I had my time again, I'd have probably went into the investment banking or private equity world, built up a lot of contacts that are very wealthy family offices, investors, built positive relationships, and then when I wanted to go and scale a property related business, then I'd pick up the phone, and be like, fancy putting 5 million into this? Yeah, sure, why not, man? Got nothing else to do. Because it's all people and relationships. Like some people I've met are so wealthy.
I think you do though, and I think I'm not saying us guys don't have great contacts. It's just our business's volumes aren't quite at the appetizing level to attract those kind of contacts just yet. But I think development is a way to tap into those sorts of contacts long term. And that is fundamentally how big developers get to where they get to. They end up with a big family office backing, PE backing, institutional backing. That's usually where it goes, because if you're in the business of being able to turn money into more money, you attract people who have money. And it's kind of that simple, and people like property.
You got to show the concept. You got to show where you're going as well. So it is a grind. It's a craft, and you've got to put that energy in. No one's going to risk on a whim.
Because I've raised money from effectively a family office, and I'm literally in conversations right now. I've had term sheets from investment banking firm in the city, and I'm also in conversations right now with a syndicate of ultra high net worth / family offices, and it's, you have to, like, these people have so many options on their plate, so many opportunities. Like they honestly really do. They're surrounded by investments all the time. Like you think out the problem when you make more money and have more money, you just have our problems on a bigger scale. Because if they have 100 million, they're looking at like 50 million plus deals with leverage. So it's like we go around, we need £1 million for this development. They're like, I'm trying to do
scratch surface.
Deals.
That's their lawyer's cost.
Yeah, it just doesn't scratch.
Scale, boys, scale and time, and that's how you make it in development. Bigger. But to be fair, there's important to provide some context here. All of our strategies are diversified. We're going small ticket at volume. In the scale of developments and property, we're small ticket in volume, compared to a slightly more traditional approach in some ways, where you'll see developers go £5 million deal to 10 million to 30 million to £100 million deal, and they might have one deal on the table each year, maybe 2, 3 or 4, and those guys can tap into big pockets quickly. And I'm sure we all know of the odd guy in the space who's got a small team, not a massive track record of site delivery, but has delivered big sites and has got that connection with that Singaporean family office or that big institutional capital war chest. And you're kind of like, you don't have as much experience as I do. Like, you don't know as much as me, but you know that thing much better, i.e. raising large sums of capital, stacking a big deal, hoping you make 10 mil, compared to me hoping to make 2 mil in the next year with a diversified, wider breadth. Like, they're different strategies.
I was in a meeting with developers. They were talking about a big site, right? About all, never done it before, nervousness, confidence, stuff like that. All I said in the room was, if you had, and ignore about anything else, because this was an experienced developer, if you had an investor, like a dozen investors that you could literally contact right now that could plug in the £15 million equity required to do the deal with you, and you knew that you could get out of one of those 12, you could get any, they were all in your phone, you've got relationships with them all, would you be even having this conversation with us now? And the answer was no, because all it was really, the problem was they didn't have the funds to do the deal. And like every development or business out there, really, if you just peel back the layers, you're only really limited by, the funding available. And that's really all about your contacts. And, I'm simplifying it really, but ultimately, if us guys now had contacts who with family office that wanted to work with us, and they said, Stu, Rye, here's 20 million. Let's build your vision. What are you guys going to do?
A lot of hate.
Exactly what I'm going to do.
Yeah. What are you going to do though? Like, if you had that,
I'm going to go and buy 30,000 square foot of office block and work my prices down as much as I can and scale that business, because one site, 6-7 million, happy days. We can.
Stuart's going to go nuts, basically.
We'll do 5 of them a year. Right? Thank you very much.
I would set up a bridging company. That's what I would do. Set up a bridging company.
And bridge it to yourself.
But what if they didn't?
Bridge it to myself.
Yeah, bridge it to yourself.
Yeah. I've got a great idea, guys. Right. Yeah.
I'll come and ask to... you can lend it to me, Rye. Yeah, I mean, that's exactly what it is. Funding is, but then you need to build... It takes time to build. Like, we've got a great investor, and he's got a wealth of a huge network. He showed me a picture of him sitting on a poker table, and he's got over £1 billion worth of of capital around that table, and and we want to tap into that and work with him and speak and try and build relationships up. But it takes time to go through a few cycles, show the numbers. We're learning all the time, and we want to keep improving that relationship. But who knows, if you just keep doing a good job, you're honest. You sort of explain where things could have gone better, and you just keep building on those relationships. And I totally believe that in time of sort of 3-4 years.
Yeah,
go on,
yeah, and I know I'm with you on that. So I'm literally doing the same thing. I had a meeting over the past year. I've met a few billionaires, and speaking with one in their office, the amount of deals they have on the table and in live investments and stuff, it is up there. Like, it takes time to, and not only just time, you've got to be there for when the time is right for them as well. And you just never know when that's going to happen. It's you've just got to carry on with your own vision, stay in the game long enough, and keep knocking on those doors. And one day, or you're only ever one yes away from a life. The only reason that my business has been able to scale the way it has, as fast as the way it has, as big as the way it has, and we're still classed as a small company, is because we secured investment from effectively a family office. That's the reality of it. If we were doing it without that level of funding and support, we wouldn't have been a fraction the size as we are. That's just simple.
You would have got there, mate. You'd have gone a different way, and you'd have taken a little bit longer. But you're totally determined, young man. So you'll make it.
Yeah,
I can't wait to look back on these podcasts in 20 years' time on the back of Dorian's yacht. He's taken over Wales completely. Yeah. Looking forward to it.
Yeah.
His yacht in Cardiff.
Yeah, yacht.
His toy yacht in the bath.
Gang, I've got to shoot. Sorry, gang. I've got to do a school run this morning.
We're getting there now, guys. But look, that was a banging episode, and we said we talked construction, and we spoke construction. So hopefully useful to anyone listening. We definitely want to pick this back up. Just have a look when Rona's coming on one of the next episodes. So if you listen to these episodes frequently, they come out every Thursday at 5:30 a.m. on Spotify and YouTube. Please do subscribe. Please do also, and Stuart recommended this last week and I forgot about it, share this with other people who you think may be useful. It may be useful for them to listen to it as well, particularly if they're in property development or construction. You've got some really good insights in this episode into what it's like running a construction business. And even if you don't have ambition to run a construction business, you can be more sympathetic to the sector and to those kind of companies and our incentives and things like that. So please do share this with any individual. We would massively appreciate it. Follow us, drop us comments for any questions for future episodes. Big love, and see you next week. Nice.